Our next guest says she expects the market volatility to continue into October, even though she remains positive on stocks for the full year. An area of the market she's concerned about, the banks. To tell us why and which stocks she currently likes, let's bring in Mary Ann Bartels, Chief Investment Strategist at Sanctuary Wealth. Mary Ann, great to see you. Good morning.
Great to see you, too.
I guess, there's one way of framing what we've been going through here as an incredibly strong market through July. Things got a little bit ahead of themselves, excited sentiment. We got maybe valuations being stretched, normal seasonal pullback in August. And then with this little rebound, 3.5% off the lows a week ago Friday, you probably have some folks thinking that was all we had to worry about. Do you agree?
No, I don't think so. So I think we can be a little, I'm calling it choppy between now and October. And I think why we're getting this really nice rally is because markets did get very oversold on that pullback. You did have S&P down around 5%. You had NASDAQ down around 10%. Nice oversold conditions. As you said, sentiment got pretty bearish. And now I think we're getting a little bit of a lift. But I'm still concerned because when we look at the intermediate indicators for the market, they're still overbought and starting to signal that we can have another correction, or we're getting sell signals. And as you pointed out, markets are expensive. Around 20 times is expensive if interest rates wind up backing up again. And if we wind up seeing that 10-year back up again and go to 4.3, 4.5, and possibly even 5, we think that's going to put pressure on the markets. So why do we remain constructive and positive? Is if we look at earnings for the quarter were great. And the best indicator of the direction of the market is estimate revisions. And we're seeing estimate revisions rise. So we do stay very constructive. We want to buy the pullback, but still think that the next couple of months can be a little choppy.
Yeah, for sure. Even through this, little bit of chop we've had, the forward estimates for the S&P have continued to rise. Credit markets have remained, pretty calm in all this. We did hint that the banks remain a worry point for you. Why is that? It seems a while since the banks were actually a real reliable bellwether for the broader market, but why does it concern you now?
Well, they're really trading, even in the rally, they're still trading very poorly. And the highlight was we looked at Citi and we looked at the relative price, meaning that we take Citi stock price, we compare it to the S&P 500, and that reached a record all-time low. That's below the financial crisis of 08 and 09. That's not what you want to be seeing in the banks. So, the regionals have been heavy, but some of the money center banks are also not trading very well. So yes, they're cheap. So we're calling them value traps. This is not part of the market that we're ready to actually buy yet.
And you say you want to buy the pullback ultimately as we get through this period. What parts of the market look like they're set up better? Well,
tech, I still think, is the leadership. Our favorite pocket of the market has been semiconductors, followed by software and services. But I think semis are the clear leadership in this marketplace. And as long as they continue to keep their long-term uptrends, I think that's a good sign that the markets remain in a secular bull market. So not only do we think that this is a good year, but we still think that higher highs can come. And we're not looking for any major top in the market until later this decade.
Yeah, interesting. Yeah, so secular bull market, meaning one that spans, a very long period of time, let's say 12 or 15 years or something like that. Do you actually feel as if 2024 is set up to be okay because you have the election year dynamics and then, at some point, presumably the Fed stops hiking and we have to start worrying about what comes next?
I think the key is going to be where do interest rates peak out? And does the 10-year and the 30-year still have to get to 5%? And they indicate in terms of their technicals that that's a possibility. I'd like to see rates get to their levels before we actually can determine where the markets are. But in general, I think if people or investors buy today, over the next 3 to 5 years, you're going to have positive gains in the portfolio.